Hello there. In the last episode, Alex learned about the difference between technical and fundamental analysis. He had a deeper dive in moving averages and price levels. Today, he is going to continue with other technical indicators. But before we get started, take a hot cup of coffee, give this video a thumbs up and subscribe to the channel. Now, we are ready to go. Candlestick patterns. First, we need to learn what a candlestick is. A candlestick is a style of financial chart used to describe price movements. In the current chart of Tesla, each bar is a candlestick. Each candlestick represents the price range of one day. A green candlestick means the close price is higher than open price for that day. In this case, the open price is at the bottom of the body, the close price is represented by the top of the body. The upper and lower sticks show the price variation range of that day. Let's pick a candlestick from the Tesla daily chart and expand it to hourly chart. What we can see is that the information about the intraday movements are already enclosed in the single candlestick. This is their biggest advantage compared to a mountain chart. A red candlestick is very similar, but in this case, the open price is higher and the close price is lower. Sometimes, the green candlestick is referenced as white, and red candle is referenced as black. Analyzing how the candlesticks behave over time, several patterns were observed. Here are the most used of them. 3-line strike. This bullish pattern carves out 3 red candles within a downtrend. The fourth bar opens even lower but reverses in a wide range that closes above the high of the first candle. This reversal predicts higher prices with an 83% accuracy. 2 black gapping. This bearish pattern appears after a notable top in an uptrend, with a gap down that yields 2 red bars posting lower lows. This pattern predicts that the decline will continue to even lower with a 68% accuracy rate. 3 black crows. This bearish reversal pattern starts at the high of an uptrend, with 3 red bars posting lower. This pattern predicts that the decline will continue to even lower lows with a 78% accuracy. Evening star. This bearish pattern starts with a tall green bar that carries an uptrend to a new high. The market gaps higher on the next bar, but fresh buyers fail to appear, yielding a narrow range candlestick. A gap down on the third bar completes the pattern, which predicts that the decline will continue to even lower lows with a 72% accuracy. Abandoned baby. This bullish reversal pattern appears at the low of a downtrend, after a series of red candles print lower lows. The market gaps lower on the next bar, but fresh sellers fail to appear, yielding a narrow range candlestick with opening and closing prints at the same price. A bullish gap on the third bar completes the pattern, which predicts that the recovery will continue to even higher highs. This pattern has a 50% accuracy. These 5 patterns are only a few examples. There are much more patterns observed. But let's leave them for now and move to the next indicator. Bollinger Bands. Bollinger Bands are envelopes plotted at a standard deviation level above and below a simple moving average of the price. Because the distance of the bands is based on standard deviation, they adjust to volatility swings in the underlying price. Let's take it step by step. We already learned about the moving average in the previous episode. That's simply the average of the last prices which is moving with the price day by day. It is represented on the picture by the green line. The next step is to understand what the standard deviation is. It is a mathematical measurement of average variance. In other words, it measures how spread out numbers are from an average value. The math behind is not complicated, but it is not necessary to handle it in order to use this instrument. Thanks to Etoro built-in tools, it can be added to the chart just with a couple of clicks. Let's do that real time. Click the Toolbox button. Then go to Section Studies 1. Scroll a little bit down and here you can find Bollinger Bands. Click on it. The configuration window appears which we leave by default. Let's only change the color here to green so that we get different colors. Now click Create. We can see that the bands appeared over on the chart. There is an upper band, a lower band, and the colored area between them is the expected variation range based on the standard deviation. Approximately 90% of price action occurs between the two bands. Any breakout above or below the bands is a major event. The breakout is not a trading signal. However, it is clear that the closer the prices move to the upper band, the more overbought the market is, and the closer the prices move to the lower band, the more oversold the market. Bollinger Bands are not a standalone trading system, and it is highly recommended to combine it with other indicators such as MiFID. So far, we got some knowledge about analyzing a stock behavior. But how about selecting a stock from many options? Fortunately, there is a technical way to do this also. It is called statistics. Let's look just at some major statistical measures. CAGR. Compound annual growth rate. This parameter shows what is the average yearly return of the asset for the selected time period. Standard deviation. We already learned what is it. The higher it is, the more volatile the stock is. Generally, a more volatile stock is considered to be riskier. Sharpe ratio. In simple words, it is the return to volatility ratio. Higher number means you get more return for a unit of volatility. U.S. market correlation. It shows how the asset moves in relation to the U.S. market. The value can range from -1 to 1. 1 means total correlation, -1 means total opposite correlation, while 0 means total independency. The correlation indicator is used when evaluating how diversified a portfolio is. If you buy 2 stocks with a correlation value close to 1, that means you did not really get a diversification, since the 2 assets will tend to move together in the same direction. These 4 parameters can be used for a statistical comparison between different stocks. Congrats if you watched the video until here. We are done with the basics of technical analysis. The next step is that you try to apply these techniques on your own. Feel free to ask questions in the comments section, and don't forget to give this video a thumbs up and subscribe. See you in the next episode.